If you're CIO of multi-asset strategies, do you see many assets that look better to you today other than stocks? How do you see the landscape?
Yeah, we see a lot of assets, including fixed income, at least as good as stocks, certainly on a risk-adjusted basis.
Still, because the argument over the first part of the year, and certainly most if not all of last year, was bonds are better than stocks, cash is better than stocks. Look where rates are, you're going to get a better a return in cash equivalents and things like that. That hasn't changed?
Well, let's go back a few steps here. If you look back to the peak back in August last year for stocks, peak to today, stocks are up about 5-6%, right about what cash has done over that time period. And that's not even getting into the details about the Magnificent Seven, the seven wonders of the world, driving the stock market, right? So without those stocks, unless you were 25% weighted in those stocks, you didn't get that return anyway. I would still say, looking back over the last 12 months or so, cash has outperformed stocks, certainly on a risk-adjusted basis. And given what stocks have done today, PE ratios up at 18, 19, very optimistic. It's not that we're ignoring what stocks have done. It's just I'm heavily discounting it. What stocks have done in the past bears no weight for us on what they're likely to do in the future. The economic stats, not looking good.
So you don't think the future looks brighter for the equity market is because the environment and the economy doesn't look
right? I don't
that
think
good to you?
I don't think we're out of the woods yet. We have inflation, granted, good news recently. Hope it's a solid trend, but still a little too high. Manufacturing statistics as bad as they were back in 08, all right? Labor market, last shoe to drop, haven't seen it yet. I don't think the stock market being up year-to-date 15-20% denies the economic cycle. We have one more spate of bad news to come. After that, maybe we'll get a little more excited.
Do you think the strength of the labor market and the apparent, strength of the consumer still defies some of the negativity that you're seeing in other parts of the economy? I mean, manufacturing's been weak and in recession for a while now.
Yes, and as was housing, and hopefully this
which has turned.
Yes, it's arguably starting to turn, right? But there are leads and lags in the economy, as we all know. It takes weeks, if not months, for monetary policy, fiscal policy to feed through or factor through the economy. I don't think we've seen the worst of it yet. We're just holding out in cash for the most part. We'll wait for one more dip.
So is it only a dip that changes your perspective? And when you can say, okay, for the first time in at least your mind in a long time, now equities look like a better bet than, say, that 5% that you can still get in cash?
We'll give it one more shot here. We're still holding out in cash at the margin. We're not out of stocks, but we're just leaning in cash, waiting for one more pullback, and then we'll find stocks more attractive. But right now, prudent caution, we think, is the word of the day.
Just give me your last view on, as you said, we call them the Magnificent Seven. We have an index that tracks those stocks. It's been remarkable what the gains have been. Do you see that persisting, and does that sort of top-heavy nature of the market make you even more uncomfortable about the market?
What I'd say is we are not overweighting those tech stocks, at least the mega caps. I know they've done very well. We'd prefer to be positioned in the near term more defensively. And by the way, I looked it up. Magnificent Seven, the 1960s movie, Yul Brynner, etc. All of the seven now deceased. I don't know what that tells you. But
well, they had long and prosperous careers and lives. Rich, it's good to see you. Thank you for being here.
Thank you, Scott.